Now, from Wall Street to State Street, the final word on today's numbers and all the day's business news. This is New England Business Day on NECM.
No change from the Fed. The Federal Reserve holds the line on interest rates for the 6th consecutive time.
We begin tonight with the Fed. The nation's central bank left the key interest rate unchanged today. The federal funds rate now rests at 5.25%, where it's been since last summer. The Fed funds rate is the interest banks charge each other on short-term overnight loans.
The Federal Reserve's Open Market Committee said that it is more concerned about inflation than it is about recent weakness in the economy. Mont Fennell is in the newsroom with more on today's Fed decision. Mont?
Indeed, Beth, the Fed is walking a fine line. Some want it to lower rates to combat a potential recession, but others recognize that inflation is a concern the Fed cannot abandon.
If only the price of goods and services did not rise and stayed at 0% inflation, then the Federal Reserve might actually lower interest rates to stimulate a slowing economy. You see, in January, the Fed figured the economy's output this fall would jump 3.5%. Now it estimates a little over 2% growth.
I think things are definitely shifting. I think the pendulum has finally swung.
But the Fed Wednesday left rates unchanged at 5.25%. It's the 6th time it's left rates flat. Not lowering rates, as some have wanted, makes it more expensive to borrow money, helping control spending and contain inflation. The Fed now says prices are rising too much, not even including higher energy costs. It's worried that low unemployment will continue to push up wages. Now, that's good for workers, but not for companies who would have to raise prices to compensate. Coburn Insight Management's John Bonanzio explains unless the Fed tames inflation, rising prices essentially would steal people's money.
It affects absolutely everyone, regardless of their wealth.
Most stocks rallied on the news. Investors liked that the Fed is no longer mentioning the possibility of actually raising rates, and it did not comment, as some thought it might, on the recent woes in the subprime mortgage industry, which has led to the closure of nearly 24 lenders and has contributed to falling stock prices.
You had the Fed looking from the inside out and not seeing the disaster that much of the rest of the market seems to have been concerning itself over.
But mortgage specialist Debbie Siegel is worried. One study shows over the next 6 to 7 years, more than 1 million adjustable rate mortgages, where monthly payments have been rising dramatically, will end in foreclosure. That's 13% of all adjustables issued between 2004 and 2006.
I don't know how they think that foreclosure rates increasing significantly every month is not affecting the economy.
In fact, in the past decade, 40% of economic growth was driven by the housing sector.
Adversely, people are not going to be wanting to spend as much money on a home. Prices are going to come down. People aren't going to be wanting to do those home improvement projects. There's going to be less cash being pumped into the economy.
But the Fed Wednesday said while, quote, the adjustment in housing is ongoing, the economy will expand at a moderate pace.
Within the subprime market, people who own these mortgages tend not to be the higher net worth individuals. They tend to be not the biggest consumers, if you will.
And that could limit a spending slowdown that could hurt the economy. Meanwhile, investors are now betting the Fed may actually begin lowering rates as soon as this summer. In the newsroom, Mont Fennell, NECN.